Happy Monday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's #2 economy. My name is Tony. Let's jump in. As General Secretary Xi Jinping leads China into the most significant political gathering of the year this week, his nation's economy is very much a mixed picture, to put it charitably. China's financial markets have experienced a surge driven by advancements in artificial intelligence, and Xi's recent efforts to reassure private entrepreneurs, including Alibaba's Jack Ma. This optimism, however, faces a reality check as Trump's new 10% tariffs are set to take effect just one day before Premier Li Qiang unveils the country's economic blueprint for the National People's Congress this week. Deep structural crises and surging debt also remain unresolved. The National People's Congress, attended by thousands of delegates, including ministry chiefs and provincial leaders, is expected to set a growth target of around 5% for the year. To reach this goal, policymakers may raise China's official budget deficit to its highest level in more than 3 decades, injecting trillions of yuan into an economy battling deflation, a property crisis, and trade tensions with the US. Putting that another way, China will reach its growth target, but yet again, it will be done with surging debt. As we've seen, in January alone, China's total debt increased by $1 trillion. Of course, some high-profile analysts have pushed back heavily against Beijing's growth claims. In an excellent report published in December of last year called After the Fall, China's Economy in 2025, US-based Rhodium Group observed, quote, China's 2024 claim that GDP growth was on track to meet high targets was impossible to reconcile with increasingly frantic efforts to prop up a flagging economy all year long. Collapsing property construction slowed growth to a crawl in 2022 and 2023, and in 2024 the spillover from real estate sidelined local government investment and consumption as well. By our estimates, China's GDP growth in 2024 improved modestly to around 2.4% to 2.8%, well below the official claims of nearly 5%. If it stimulates domestic demand with some urgency and ramps up debt, we think China could get 3 to 4.5% growth in 2025, reaching the high end of that range only if everything falls in Beijing's favor. But that is very top of or above the potential growth ceiling until Beijing fixes long festering structural problems. End quote. Meanwhile, Trump's trade policies are pushing China's leadership to bolster domestic consumption. Unlike in previous years, China can no longer rely on export growth to drive its economy. Instead, authorities are prioritizing domestic demand expansion. Economists, including Peking University's Yao Yang, warn that the proposed fiscal stimulus may not be sufficient, especially given concerns over local government debt. China's monetary policy will be closely watched, particularly regarding the stability of the yuan. The People's Bank of China has consistently set the yuan's fixing rate above 7.2 per dollar, resisting pressures to devalue the currency in response to trade war losses. Despite Trump's tariffs, Beijing appears determined to maintain stability rather than resort to drastic monetary easing. However, it is still early in the year and early in this trade war 2.0, so we'll have to follow this space closely. According to US-based Bloomberg Economics, the trade war is a key topic behind closed doors at the National People's Congress. While China's budget stance is unlikely to shift immediately, escalating external pressures may prompt a more aggressive stimulus later this year. Analysts predict the government will need to increase fiscal expenditure to counteract the impact of tariffs, with export growth expected to slow significantly. To sustain growth, China is likely to raise its official budget deficit target to around 4% of GDP, up from its already historically high 3% in 2024, and this is on top of decades of deficits. Economists expect the government to issue 2 trillion yuan in new special sovereign bonds and set up 4 trillion yuan in new special local government bonds. These measures aim to stimulate the economy while addressing risks associated with mounting debt. Meanwhile, concerns over deflation are also growing, with China expected to lower its inflation target to 2%, the lowest in over 2 decades. The government is likely to focus on heating up demand to prevent further economic stagnation. While facing economic headwinds, China remains committed to its technological ambitions too. Breakthroughs such as the AI chatbot DeepSeek have reinforced China's push towards self-sufficiency in high-tech manufacturing. According to Goldman Sachs, AI adoption could raise China's potential growth rate by 0.3 percentage points by 2030, suggesting that putting all its proverbial eggs in the AI basket is not a winning strategy for sustainable growth. And on this theme, Beijing leadership increasingly sees AI advancements through national security lenses, despite complaints from Beijing that the US is widening national security concerns too much to justify chip restrictions. And this brings us to our next development. But first, this month's sponsored feature. I'm quite excited about this one actually, and if you'd like to know how I work with sponsors, this is in the description below. US President Donald Trump's first 45 days in office have made it clear that he is putting America first. His stated energy goal is to drill, baby, drill, unlocking America's vast riches. He has already snapped tariffs on aluminum and steel, promised copper is next, and from the USGS Mineral Commodity Summaries 2025 report, quote, copper is a critical mineral due to its essential applications in energy infrastructure and defense, with US production of 1.2 million tons offset by significant imports, highlighting supply chain risks. End quote. The deepening geostrategic competition with China is only reinforcing this trend. On the 14th of February, Executive Order 14213 was issued by Trump's National Energy Dominance Council. This directive implicitly prioritizes copper as a critical resource because of its pivotal role in national energy security and economic strategy. Given that China consumes 57% of the world's copper, the executive order emphasizes the urgent need for the United States to enhance its domestic copper production. And today's video sponsor, Giant Mining, gives savvy investors just the opportunity to take advantage of these trends. Not only does it own and operate a copper, silver, gold project in Nevada, it has also recorded its best ever drill intercepts in September of 2024. Nevada, where Giant Mining's copper project is situated, consistently ranks among the top mining jurisdictions in the world. Giant Mining's treasury is now fully funded for its drilling programs in 2025. Giant Mining is well positioned to accelerate its exploration efforts and potentially capitalize on emerging copper market opportunities. Giant Mining owns the Ajuba Hill copper project, a past-producing mine. In the past 4 years, management and the company's geologists have actually expanded the copper deposit, and this past September, Giant Mining hit their best ever drill hole. BHP, Billiton, and Rio Tinto, two of the largest copper producers in the world, are warning that copper supply cannot possibly meet the future demand from artificial intelligence and the construction renaissance in the US. Goldman Sachs warns of a deficit deepening in 2025 through 27, with prices potentially hitting $15,000 a ton. BMI predicts a looming supply deficit driving long-term price gains. Meanwhile, the share price of Giant Mining has depreciated from a peak of $4.20 US on January 13th, 2023 to only around 27 cents today, more than 90% lower. But since Trump's election victory, the share price has doubled already. So we have a company well below its all-time high, a mining-friendly administration, copper coming back to America, the geopolitical trends reinforcing this process, and a serious asset in Nevada. This is a speculative play, high risk, but also a potential very high upside. As such, Giant Mining is worth considering due diligence on for any savvy investor seeking to take advantage of the historic changes we are seeing in the world today. We remember that all investment involves risk. This sponsored feature is not individual investment advice. Always do your own due diligence and speak to an investment professional before making any investment decision. A big thank you to Giant Mining for sponsoring this episode of China Update. We now return to regular content. In an exclusive published today, US-based The Wall Street Journal reports that China is cautioning its leading artificial intelligence entrepreneurs and researchers against traveling to the United States, reflecting the government's emphasis on AI as a key national security and economic priority. Sources familiar with the matter indicate that Beijing fears these experts might inadvertently disclose confidential information regarding the country's AI advancements. The ongoing technological rivalry between the US and China is intensifying, particularly in the space of AI. Chinese firms such as DeepSeek and Alibaba are emerging as competitors to US giants like OpenAI and Google. As a result, Beijing is exerting greater pressure on its technology leaders to align with state interests, further widening the divide between the two nations' tech ecosystems. This division has been exacerbated by US semiconductor export restrictions under the Biden administration and tariffs imposed during the Trump presidency. While there is no outright travel ban, officials in China's major technology hubs, including Beijing, Shanghai, and Hangzhou, home to AI leaders DeepSeek and Alibaba, are advising AI executives to avoid travel to the US unless absolutely necessary. Those who do travel must report their plans beforehand and debrief authorities upon their return. Recent examples highlight the effects of these directives. DeepSeek founder Liang Wenfeng reportedly declined an invitation to an AI summit in Paris earlier this year. Similarly, another prominent AI startup leader cancelled his US visit last year following guidance from Beijing, the outlet writes. Just 2 weeks ago, Xi Jinping met with key business leaders emphasizing their, quote, national duty, end quote, in advancing technology. Attendees included Liang Wenfeng and Unitree Robotics' Wang Xingxing. Beijing's scrutiny of entrepreneurs with ties to the US has historical precedent, as illustrated by Alibaba co-founder Jack Ma's meeting with Donald Trump in 2017, which drew Beijing's ire. Despite these restrictions, cross-border interactions persist. Chinese firms, including Unitree, participated in January's CES tech event in Las Vegas. Analysts suggest Beijing's primary concerns include technology acquisition by American firms and brain drain, with many Chinese entrepreneurs relocating overseas in recent years. A crucial test of continued collaboration will occur this summer when China hosts its own AI summit, with Foreign Minister Wang Yi inviting global participation. Whether this signals a shift in policy or remains a controlled engagement remains to be seen. And finally for today, last week, the recent revelation about the Chinese government's financial support for American-born Olympians Eileen Gu and Beverly Zhu have sparked heated discussions online. Indeed, it blew up to quite the online scandal. The Beijing city's government's budget disclosure originally included a notice detailing 48.14 million RMB, approximately $6.6 million US dollars, allocated for the training and preparation of the two athletes ahead of the 2026 Milan Winter Olympics. However, this information has since been censored across Chinese media, including the removal of a report from Chinese financial media outlet Caixin. Eileen Gu, a freestyle skier, rose to prominence during the 2022 Beijing Winter Olympics, securing 2 gold medals and a silver for China after switching her national allegiance from the United States. While she has been celebrated as a national sports icon in China, her substantial earnings from endorsements, reportedly in the tens of millions annually, have fueled public discontent regarding the necessity of such significant state subsidies, especially at a time when the economy is doing so poorly and so many Chinese are feeling the pain. Meanwhile, figure skater Beverly Zhu, also US-born, faced sharp criticism for her underwhelming Olympic performance. The budget disclosure originally appeared in a document published by the Beijing Sports Bureau. The document explicitly mentioned that both Gu and Zhu had signed athlete service agreements to continue representing Beijing in competitions, with the aim of enhancing the city's winter sports competitiveness. However, shortly after the information went viral, references to the two athletes were removed from the official government website. The controversy underscores broader debates over resource allocation, nationalism, and the role of foreign-born athletes in China's sports strategy. But like I said, it could also simply be a sign of the economic times and the frustration that this has caused across much of Chinese society. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Monday, have a productive week, and I will see you all tomorrow.